Chapter. We're talking real money.
Welcome to Talking Real Money, the radio show that becomes a podcast. I'm Don McDonald. Tom Cox over there with me, as he usually is, but won't be for a very long time upcoming.
You are going to complain about that until the moment I get out of the country, aren't you? Okay,
and then
fair enough.
I'll even complain about it after you're out of the country.
Then it's a legit complaint.
Matter of fact, I might complain even more. We're here to talk, about your money in a really important and really understandable way. And I want to set your expectations for today's program at a low level.
Like every other program, you mean?
No. Because lower.
Oh, wow.
Because I'm talking to you via tin cans and strings.
Basically, you are. I saw this the can run right into the room here, so I'm holding firm.
Because I have a $5,000 device, as does Tom, sitting right here next to us, called a Tie-Line Via. It's a very, very, very expensive device that takes our voices and does something fancy and sends them over the internet back to the radio station where it gets turned back into high-quality sound at the other end. Well, I overnighted my Via last week for repairs, and they sent it back, and it doesn't work.
It literally does not work.
It does not work.
It's not like
just does not work.
Bit, not at all. Yeah. You sound the same, though. I got to say.
The repairs were about $900, almost $1,000.
I have the receipt. I'm gonna reject it, so I'm just not gonna pay.
On a bicycle. So I'm doing this actually through a software program that they write that is on my iPhone connected to the internet.
Crazy.
So it's working, but think of a string. That's what I want you. I want you to think of a string. And I want you to call us, too, if you'd like to ask a question, because the good news is you've got two of us. So if one of our strings breaks, you still got the other one.
Which, frankly, at this age is likely anyway.
It's not our strings that break. It's just every other thing on us. 855-935-TALK is our phone number. That's 855-935-8255. See, we get together on Saturday afternoons, and we invite you to call us so we can talk one-on-one, which is our favoritist part of the whole get-together. It's the thing we like to do best. But we also feel that we should share things that we find useful or compelling in the world of money. Now, I wanted to start with Hello Kitty, but
the kids' show airs earlier in the day. Sorry.
No. I can't call him Roaring Kitty because he's just goofy looking. He's just like, Roaring Kitty, I know it's almost oxymoronic.
You're going to do it anyway. You're going to go right to the thing we decided we weren't going to do.
Okay. What I'm going to do now is I'm going to go to something much more important.
And now for something completely different.
From our friends at Kiplinger's former magazine, now a website.
They don't print anymore?
I don't know. They probably do. But does anybody actually
Yes, I still get many printed publications. Have you physically seen a magazine? I get Bloomberg Business Week. I get
in paper.
I love it. Absolutely, you know that. I get a lot of them. Smithsonian, Wall Street Journal, Seattle Times.
Paper.
Paper.
All right. Okay, I guess they still publish.
Business Journal. So,
I don't pay any attention to paper. This is from a CPA who apparently writes for them by the name of Joe Mayer, talking about the 7 deadly sins of wealth management. And it's a little bit more eclectic than just the 7 deadly sins of investing. This is more ethereal. It's mystical in some ways. It feels very new agey in a lot of respects. So we've got 7 of these sins
kick you in the shins
that we're going to share with you.
Okay, yeah.
Now, bear in mind, Tommy is going to go searching for seashells by the seashore in the Seychelles.
That's true. So, you're lucky I might send you one.
I'm good with that. So, Tom?
Yes.
Why don't we do the first deadly sin and just get it over with?
Okay. I love this first deadly sin. The first one is not starting with a purpose. And we'll tell you what that means in a moment, because this is the big sin. You don't want to commit this one.
Not starting with a purpose. See, I would. So it's different from not starting with a plan. That's what I think we're going to say. 855-935-TALK is our number. Please call.
Tom and Don are talking real money.
In medicine, a second opinion might save your life. With investing, a second opinion might save your future. The trick is getting one without a high-pressure sales pitch. Well, I'm Don McDonald, and if you've been listening to Talking Real Money, you know that our goal is to help everyone create a brighter future by investing and managing money better. That's why, in addition to helping everyone on our show and podcast, we are also committed to making our 100% fiduciary advisors at Appella available to help everyone make the best financial decisions based on science. So if you're being pitched a financial product or a system, make sure you get a second opinion with no cost, no obligation, and no annoying sales pitch by going to TalkingRealMoney.com or call 800-386-3004. That's 800-386-3004 or TalkingRealMoney.com.
Your guides to a really great financial future. Tom and Don are talking real money.
Hello again. I'm Don. Tom's over there, and we're here to, throughout the hour, we're going to share with you we're going to try to share all seven deadly sins of wealth management, and which is not starting investing with a purpose.
Because you don't know what success is. If you're just sort of saving to save, and we run into this all the time, like I'm setting this money aside, or people that are already in retirement, I'm still setting aside that. Why? Why are you doing it? What are you trying to accomplish? If you're trying to accomplish being the richest person in the world, that's not going to happen.
You're going to lose.
You're going to, because isn't Musk getting another like 46 billion or something here?
I can't believe what they're talking about for compensation.
It's insanity. So you're not going to, so it should be instead, generally in this order, retirement, right? Generally. It could be for other members of your family to help them out. It could be for charities, but it should all have a meaning to it. And that's what the author is talking about here, that people have these power emotions, happiness, contentment, success, or fulfillment. You gotta know which one of those matches up with the saving part and the investing part before anything is done, frankly.
See, I would have started with a plan. I don't know. That's just me. 855-935-TALK. More of the 7 deadly sins coming up. But first, Drew, you're up, and welcome to Talking
Real. We're going to do the
Real.
sins on the show? Okay. All right.
Yeah, not those. 7 deadly sins of wealth management. Sorry. We can do the 7 deadly sins. Hi, Drew. Welcome to the program. Drew? I'm not even hearing phone line sounds.
Me either.
It's not a good sign.
That's not a good sign.
Well, should we try Brian? Ryan. Okay. We're going to go to Ryan. Ryan, hi. Welcome to Talking Real Money.
Tom, thanks for taking my call. I was wondering regarding VBR in my brokerage account. I have my brokerage through Vanguard, so VBR was a pretty convenient choice. But I remember on a previous show, you talked about the idea that the size of the assets was larger than some of the comparable funds.
Mm-hmm. Yes.
And would that be to the point where you would say it is worth looking at one of those other options for small cap value? Or if you already, I'm just more thinking I don't want to have to open another fund.
My opinion is I think we're getting into the weeds a little bit when we start looking at small cap. If you have VBR,
said,
you have small cap growth. The returns have been different.
Yep,
but
and you do have smaller, much smaller companies. AV.
But it also is going to. It's also likely to increase your volatility.
It should. Yeah,
it
you
should
would expect that. Yeah,
so
things are up and down more. But both the price to book and the size of the company appear to put the odds in your favor owning AVUV over VBR, for example.
What would you guess though the expected difference would be over the course of several years?
I'll say 1% to 2%.
You think that much
Well,
between
it has
VBR?
been the last 5 years. Remember, we did this piece not long ago. We looked at the last 5 years, and it has been substantial difference between VBR
versus which one?
AVUV.
AVUV?
Yeah, it's been a lot. So, but you're right. Will it always be that way? I don't know. And so maybe there, if you really want to get complicated, you put some in both. You have some in VBR and you have some in AVUV.
Now it's starting to sound complicated,
though. Now you're getting a bit of a hodgepodgery here, but it's been a big difference. The size, as I say, of the companies are much smaller with AVUV, and they have a much greater sort of value tilt, if you will, than I meant to say AVUV over VBR. Smaller companies and more value-oriented firms. And has that been better in the long haul? Yes.
It's not a. I guess the thing is, it's not a clear, like, it's not so significant that it may justify it. May be more just something to look at, but it's not so significant that VBR is not sufficient for that, like, style of asset.
One of the problems we have is that if you're just looking at past performance, you'll see that AVUV doesn't have very much. It's only been around for a little over 3 years. So it's got a 3 year, and it has over 3 really soared over VBR.
And it's a lot. The difference,
really, I mean, like
3-year
return is 6% on AVUV, and it was 3% on VBR. But is that okay? I hate to compare short-term performance. I really do.
It's very short.
But,
I agree.
But you should expect. I would expect less than a point more long-term. That would be my expectation.
I said 2. Don says 1. Now you're at 1.5. So it's worthwhile, I think, then in that case, right?
What's the difference? Okay.
We don't know. We don't know.
Time for one more question?
We have no clue. Yes, go ahead.
Okay, so I'm just wondering if you have a pension as part of your work, and you're comfortable that it's a pension that's well funded, that it'll be there when you retire. How would you factor that into like a risk, stock to bond ratio? I mean, I feel like it's almost like just another annuity of sorts, and it makes me wonder if I should lean more towards riskier assets if I'm comfortable with that.
Yeah,
to be able to balance it out.
And again, we're coming back. We need to come back to the real purpose of risk. You add risk to a portfolio because you need it. Make sure you need it first. If you're going to go into retirement with a pension and Social Security and a big old portfolio that you've built well over time, well, then once you start collecting that pension, you may not need to take as much risk. So I don't think it comes down to an absolute formula. And I personally don't like assigning a value to a pension.
Thank you.
Because it is not an actual spendable asset past your death.
And Don's correct. If you need the return, then yes, take on the additional volatility. If you don't, I wouldn't. And again, you can't consider that pension as part of your overall asset allocation because it's not an asset in there that's going up or down, right? The way that stocks or bonds would. The most of the issue we see, most of the time, Ryan, what we see is people who do that and then move most of their money to stocks, and then the stock market goes down substantially. Their portfolio goes down 35 to 40%, and they say, "Hey, that was horrible. I got to move some money. I got to take action. I got to do something." That's when the real trouble starts.
Yeah, and that's the big issue. This is allocation shouldn't be done in a vacuum. It's not just an absolute thing. Well, I can take this much risk, so I should be invested like this. That's a very simplified approach to it. That's why I try to use the term risk profile as opposed to risk tolerance, because it is so important to look at your needs in retirement and then look at the things you have to fill those needs, pension, Social Security, portfolio. And if you don't need to take risk, well then, again, as Tom said earlier, why would you take it? Because you're not going to win the I'm the richest guy in the world lottery.
That's really interesting, because I was almost thinking of it the other way around, of saying, oh, I have this guaranteed benefit, therefore I could take on more risk and know that will be there for me. But
you don't know it. See, there's the flaw in the logic. We don't know it. We take extra risk because the outcome is unknown, is uncertain. That's why we get rewarded for it, because of the uncertainty. So we can never say with certainty that my stock portfolio is going to be there for me in the future. We can't say that. We can say we expect it should be, but why take on that uncertainty, at least to the higher degree, if you don't need to? Yeah.
Okay. Awesome. Okay. Well, thank you for your time. I appreciate it.
You're very welcome. Thanks for being a part of the show. 855-935-TALK is our phone number, 855-935-8255. When we come back from the break, Tom is going to share with you, I know you can hardly wait.
Yeah.
The second
Is it going to be greed?
Sin.
Is it going to be gluttony? I
Not
think it
deadly.
might be sloth. We'll see.
Well, sloth is like the whole office right now. Sloth. 855-935-TALK.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
Hi there. Welcome back. Our number is 855-935-TALK. And in Kiplinger's publication this past week, they published an article by Joe Mayer, who's a CPA and a JD, by the way. He's a lawyer, juris doctor.
Apparently a smart guy.
Called The 7 Deadly Sins of Wealth Management. He's a very esoteric kind of guy, too. And now, ladies and gentlemen, without further ado, sin number 2.
Starting for your destination without guidance. I think you're that's
wait a
what
minute.
you're
Are we talking about money? Where are we going on a trip?
But just a plan. I mean, this is what you were kind of said at the beginning. How can you do anything without the plan? And I think for me, it is the purpose first, because here's what I want to do. Here's how I'm going to do it.
I'm starting to see this coming together.
Exactly. I mean, it's, it's not gluttony, but it is, trying to move on without, knowing where you're moving. I think that's smart. I really do.
And what should that plan be like? What should it consist of?
For anybody?
For anybody.
Wow.
What do you need in there?
A lot of things. I mean, it's
a lot of stuff. Okay. Thank you, Tom. Everybody, you need a lot of stuff. I mean, I guess what I'm getting at is the plan. It has to be an ongoing thing.
Yeah, it's a living, breathing document.
Yeah,
yes.
You can't just say, well, okay, I'm going to plan for this amount of money right now, and you don't ever change it. You've got to keep looking at it, looking at your needs, looking at your risk, and I was going to try to get into the risk profile. You got to have that in there, all of that. So 855-935-TALK. Tim, you're up. Welcome to Talking Real Money.
Hi, guys. Thanks for taking my call. I discovered you guys a couple of years ago. I really enjoy your program. We listen live every Saturday back here on the East Coast. My question's about pensions. It's kind of good with that guy just on. A pension plan, my company still offers a pension plan. When I retire, is there any reason to leave the pension with the company? If the company runs into financial difficulty, that's an asset of the company. Why is it a lot simpler just to roll it into an IRA? I know what's in the plan. I've researched the plan documents. I can do just as well by managing it myself rather than leaving it with the company and putting it at risk there. Is there any reason to leave it with the company?
Well, we had this come up a lot with Boeing when they were offering.
Question. So you're talking about a lump sum versus an annuity payout? Is that what I'm hearing?
That's what he's saying.
Yeah. When we retire, you have the option to roll it, to an IRA. Mm-hmm. I don't want to leave it with the company because, as it has been in the news, if the public workers, something like that, the pension plan goes bad or the bank fails, that's an asset of the company. It's not your asset. Why not just remove the risk, get it totally away from the company, and I'm good to go? It's all my assets that I control.
I get that part of it, but that is removing one risk. I mean, there is the risk of you putting in an IRA and then losing a lot of money and not being able to pay yourself what you would have gotten from the annuity. That could happen. That's another risk. Let's say you take it all, you roll it out, say, I'm going to put it in the Vanguard Total Stock Market Index Fund, and it goes down for 3 years in a row, and you can't pay yourself what you would have gotten guaranteed from the pension provider. That could happen.
But the pension plan invests in stocks, mutual funds, municipal bonds, same thing. I could mirror it exactly outside of the company. I mean,
but
there's
guaranteed payout.
There's one other component there too, and there's the issue of the pension plan having more assets than you will have if your portfolio gets into trouble. But and while it is not certain, there is the Pension Benefit Guarantee Corporation that is supposed to kind of stand behind. But you're right. I mean, I know you're going to say that may not happen, and it may not. But the fact of the matter is, the real issue needs to be: are you comfortable? Because I think taking the lump sum is a smart strategy for someone who is risk tolerant.
That's exactly right. You've got to be willing to accept the ups and the downs versus just getting a regular check.
And if you are, then it can be far more lucrative because you may very well be able to pay yourself a comparable income. I'd have to look at the numbers, but we've run the numbers before for lots and lots of people. And you can pay yourself a comparable benefit and still have the asset.
It's yours. I think that's yours.
I know we're up against the bottom of the hour, but we're talking two different kinds of risk. I get the investment risk, what you guys are saying, but the risk I'm talking about is leaving it with the company. Companies do fail. And they do, and that's outside of the company.
So far, the guarantee fund, though, the government fund has been able to step in and make most of these things.
Not everybody,
but most whole. Most whole. It is a risk. I got to tell you, the only thing I can do is talk about me. If I was in your shoes, and I am certainly old enough to be taking a lump sum from a pension if I had one, I personally, because I know my risk tolerance, would take the lump sum.
Tom and Don are talking real money. Reality radio for a really great future. We're talking real money.
Hi again. I'm Don. That's Tom. This is Talking Real Money, the radio show, and then the podcast next week. Glad you could be there. Our phone number is 855-935-TALK. And today we're talking about an article from Kiplinger's that's about the 7 weird, deadly sins of wealth management. I added the word weird in there because these next two, I'm going to ask you to do the next two together because I kind of don't get the concept in either one. Sin number 3, not making cash the king.
Easy. Yeah, I can do that in a second.
Sin number 4, letting dollars be lazy.
Yeah, okay, I'll do the. I do want to mention quickly to Tim, who I know is listening back east, that Don and I will be in beautiful Glastonbury, Connecticut on October 19th. So come and see us at Retire Meet East. I was going to throw that in, but we ran out of time.
He's in Corning, New York. That's a ways away.
How far? I don't know. Isn't it all like within 15 minutes or something back here?
Man, you do think New England is smaller than it is, don't you?
We're out here in the West. Everything is big. Yeah. All right. So come and see us. That's Retire Meet East on October 19th. So we'd love to see you. Number 3, not making cash the king.
What does that mean?
I think that means don't let your money sit around and not do anything for you.
Is that what that says?
I think so.
Okay.
In other words,
but then he says, don't let your dollars be lazy.
But isn't that
the same thing?
No, I think that's, for me, that's, figuring out what to do with each dollar. In other words, should you be saving it? Should you be spending it? Should you be giving it, whatever it is? It shouldn't just be sitting there without, going back to number 1, purpose.
Is just investing at purpose enough?
Well, it depends on what you're investing for. Are you investing to buy a house? Are you investing for retirement?
Okay, this is a little esoteric for me.
It is. I agree.
It is. It really is.
Yeah.
It's like it's very Zen. This is Zen money management to me. This is like woke.
Oh, that's our next woke.
One. Zen this is like woke money management.
No, we are not going there, my friend.
Don't even say the
phone
word
system
woke,
won't take it on. Well, so anyway.
Okay. All right, I guess I don't get it, but thank you.
And speaking of the phone system, apparently the email system doesn't work either. Are we going to mention
this? That.
All right.
No, I don't think we mention that right now because we're having enough problems. 855-935-TALK is our number. And Drew, you're up next. Welcome to the show.
Hey, Tom and Don. Thank you for taking my call. I'm a short-term listener, first-time caller, and I have some questions about retirement investing.
Yes, sir. Yes. Please.
It kind of has to do with your second deadly sin. You talked about, guidance and stuff. What do you recommend for somebody to find a financial advisor? How much should it cost? How do you find somebody who's going to manage your money for you, advise you on how to to invest that retirement money, because I'm getting to a place where I want to start putting. I'm in sales. I don't have any 401k program to be a part of, so I'm going to be doing all this on my own. And I know you talk to a lot of people that are pretty savvy in this area, but I'm really not. I kind of want to hire somebody to do that.
Can I ask you a quick question that'll help, though, a little bit as to where you need to go? How much money do you currently have invested, and how old are you?
I'm 44, and I have about $80,000 in a 401k. I don't think it's an IRA; it's 401k, and then I'm about $80,000 in a company stock that I'm getting to the place where I'm able to sell that and invest that as well. And then I'm hoping to put 10% of my income in there, which would be roughly $1,000 a month. So I kind of want to get it right. The person that I choose to go with.
Yeah, and so do you work for yourself then? Is that what we're hearing, or you work for a company, or who's your employer?
I work for a company. I'm in sales. I work on commission, and
okay. And do they don't have a retirement plan? Is that what I heard you say?
They do not. Yeah. They don't. Yeah,
okay. So this is all going to be from you. Yeah. All right. Fair enough. Which is a small disadvantage.
Here's the
because
thing.
he can't save as much.
Right. He can't. Yeah. But he can still fund a Roth. He can.
Yeah. And then after tax.
And then after tax. But here's what my concern is. I don't want to throw you to the wolves.
That's the problem.
And
that's what happens when you look it up on Google or something. You get it's just sales. They're just trying to get
exactly. As you know, some of the easiest people to sell to are salesmen.
Absolutely.
I know. I was one. The problem is 99. Get this. 99 out of 100 financial advisors in America, according to MarketWatch, are not always required to act in your best interest, which means they can, if they choose to, take advantage of you. So, hang on.
Tom and Don are talking real money.
Do you suffer from hodgepodgeitis? I'm Don McDonald, and hodgepodgeitis is a disease of your investment portfolio whose symptoms include lots of stocks, loads of random loaded mutual funds, and maybe an annuity or two. Most who suffer from hodgepodgeitis dread opening their quarterly portfolio statements. They feel lost and confused. Investing seems overwhelming and the financial future uncertain. If you believe you suffer from hodgepodgeitis, see a 100% fiduciary investment advisor immediately. A proper diagnosis is the first step to creating a portfolio with a purpose based on a personal plan. Start on the road to recovery now by scheduling a free meeting with an Appella advisor at TalkingRealMoney.com. There is no cost, obligation, or high-pressure sales pitch. Take the first step at TalkingRealMoney.com or call 800-386-3004. Hodgepodgeitis is not a real disease, but treating it has been shown to improve mood, reduce fear, and even lead to a brighter financial future. Results may vary.
Your guides to a really great financial future. Tom and Don are talking real money.
And we are chatting with Drew about basically how to get a retirement plan going, how to get invested for retirement. Right now, he has some stock from his company that he can sell soon. He's got $80,000 in a 401k from a previous employer. He has no 401k at work. He's going to try and save about 10% of his income for the long haul, which I think is probably a decent number. Depends on what your needs are.
Sure.
But I think the thing you really need to do right now is determine, because you're limited in how much you can put away. I would put the maximum into a Roth every year.
If he's Roth eligible.
If you're Roth eligible. If not, I would put the maximum in an IRA every year, if you can. And then invest outside of that. But at this point, I don't think you need someone guiding you on your investment portfolio, because I think that opens you up to too many potential problems and misleading people and high fees, to be honest. When you're in the beginning of the process of adding assets and trying to build that portfolio in the accumulation phase, we believe that you can probably, at the initial part, do well with just a couple of funds.
Yeah, I think you could go very easily, for example, to Charles Schwab, schwab.com, Decumulation.com. Open up an Roth IRA, as Don said. That'd be easy to do. Open up an IRA. You want an IRA and a Roth. Take the money from the 401k. Schwab will help you do this. Roll it over to the IRA, right? And then start putting money into the Roth IRA. Again, assuming you're eligible. There are income limits there. I don't know how much money you make.
How much do you make?
It's about 100. The cap could be 100 or 150. This year. So.
Okay, you should be eligible.
Good. He's Roth. You're Roth eligible.
And then again, I think for the Roth, I would own one exchange traded fund. There's two options, but we can make it simple. The AVGE, that's the Avantis Global Equity Fund. Everything goes into there. Then with the money in the IRA, which is going to be the larger amount, you could own the Vanguard target date 2050?
25, yeah, 2050.
Something like that, one fund. Don's exactly right, though. You don't really, because if you go out and end up in somebody's office, Edward Jones, I see this all the time.
Yeah.
With relatively small amounts of relatively simple situations, they get sold into all kinds of stuff because they just didn't know. So I would probably use one fund in each one of those and get on with your life. And then if you're able to exceed how much you could put into the Roth,
which is
then you open a
regular
taxable. Yeah, you open a regular taxable account, put it in there, and do the same thing with one fund. I'd keep it simple.
Yep. You really need the help. You're going to need the help when you start accumulating a sizable amount of money and you start getting closer to using it. It's both it's a combination of the amount of money you have and what your needs for that money are going to be in the nearer future. So for right now, you're an accumulator, 1 or 2, 3 funds max. That ought to take care of you. And honestly, I don't mean to tout our show, but if you just listen to our podcast regularly, you're going to go, oh, I'm feeling pretty comfortable about this process. It's not as hard as it appears.
So you recommend for me to really not go with an advisor, but just go directly to investment firm and
Yep, to go directly to Schwab or Fidelity or whomever and open those accounts and then use very low cost passive ETFs.
What are the low costs? Like what should that range be? Like the amount percentage wise?
Less than 1/4% in most cases.
Yeah,
certainly less than a half.
Yeah.
But 1/4% is normally about right, and you shouldn't be much higher than that.
By the way, somebody just came in the other day to Ed Jones with a relatively small amount, and they were paying 1.71% a year.
Yeah.
It's like, you don't need to pay all that. No, that is not what you should do in today's world, period.
Less than 1/4%, and that's charged quarterly. Is that what they do?
And that's daily, actually.
It's charged. It's an annual fee against the portfolio on a daily basis, but it's a little sliver of that every day. So it's pennies. Literal pennies. So that's what I would do, Drew. Thanks so much for the call. We really, truly appreciate it. But we need to get another of the 7 deadly sins of wealth management in here, and that's number 5. Okay, it's another wacky one. Go ahead.
No, this is really good. Assuming investments
you are thinking it's better than I am.
Assuming investments are an end rather than a means. I see this all the time. This is very pretty close to envy, by the way, which I think is one of the 7 deadly sins. You are investing for you and what you're trying to accomplish. You should not be comparing it, for example, to others. You shouldn't be looking to say, I wish I'd been in Tesla when it went public. That has nothing to do with nothing, period. Just like Drew should decide on what rate of return he's trying to accomplish, buy the products that will do that at a low cost, and forget about everything else.
I did forget to mention to Drew, go to talkingrealmoney.com and take the risk quiz.
Yeah, well, and also
just find out what your risk tolerance is.
Yeah, you have funds there you could use. So I think that's a big one. I see this all the time. And what happens is, right, what do people bought at the beginning of the year because everybody else made money in it? Tesla, for example, which is down like 30% year to date.
I thought you were going to say GameStop.
Okay, AMC, sorry. I mean, no, but there's a lot of that kind of thing like, oh, I wish I'd done that like they did. I got to find that out. And people make big mistakes sort of following others.
And let's go back to the phones. Wes, you're up next. Welcome to Talking Real Money.
Thanks for taking my call. Sorry, Don, I'm not going to see you on your road trip in North Carolina the day you decide to stop. I'll be in Tennessee.
I'm not going to Tennessee.
You can make a detour to Tennessee.
I'm going to Virginia.
No, he's saying
Tennessee.
He's going to Tennessee because he heard you
I
were
know.
going to be
I
in
said
Carolina.
I'm not going to Tennessee.
I think that's a wise choice, Wes. If I knew Don was coming to my town, I'd ride on out of there,
get the heck out, too. Yeah, he's such a liar. He's flying to Madison to see me. He can't stay away.
I miss you, man.
What's up, Wes?
Hey, bromance, man. Bromance. I got a daughter who's 25. I've helped her set up her Roth IRA. She's putting her $7,000 in it. And I've got VTSAX at about 90% and AVUV at about 10%.
Yeah.
You're a good dad.
Should add like VT to it?
No, because that's redundant. I mean,
that's the same thing. VT's the same thing.
No, I think that's pretty doggone good asset allocation.
Now,
Isn't
one
VT
thing you
Sachs,
could do,
that's the total world.
That's the total world, which is just what VT is. What you could do, what she could do, is without any fees or costs, without any problem whatsoever, move from VTSAX, which I think is a little bit more expensive
marginally
than VT.
Not much,
so, but it won't save much.
No, but you could go. What Don is saying, move from that global mutual fund to the global exchange traded fund. It holds basically the same securities. But I love the fact that you have a global portfolio plus throwing in just a little more of that small value you're getting from AVUV. I think you're going to have a great Father's Day is what I'm thinking.
Oh, you should.
And the other question, if I had y'all working on my personal portfolio, I know it's somewhere around 1%. How was that paid? Do I write a check yearly to you, or you take it out of my assets? How does
Don
that
will be
work?
by when you're in Tennessee to pick up the money.
Yeah,
keep it there in gold.
I come by. Yeah, we need it in gold bars or crypto, please.
Yeah, crypto. We'll give you the wallet number here in a moment.
It could be taken out of the account or paid.
Okay.
Yeah. Either way.
Right,
if you
Tom,
pay it, one of the cool things about paying it.
I'm
sorry?
I'll be talking to Tom. I'll be calling in for my trip through my messed up portfolio. What's your catchphrase?
What's your catchphrase?
Do it now before it's too late. I don't know.
Thanks for the call. I don't know what he's talking about. 855-935-TALK. Oh, hodgepodgeitis.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
855-935-TALK. That's our phone number. Give us a call anytime. Well, on Saturday afternoons between noon and 2 Pacific time.
Anytime, yeah, sure.
Almost anytime. We're talking about the 7 deadly sins of wealth management from Kiplinger's whatever, by Joe Meyer, JD CPA. And we are now up to number 6.
I'm working on sloth heavily here in about an hour and 10 minutes, too, by the way. Count me in.
Yeah, I'm thinking the same thing.
Okay, number 6 is walking up and especially down the mountain without a Sherpa. What he's talking about here is that more people die going down from Mount Everest than going up. Why?
Oh,
because
so
they don't
he's
have
saying
help.
On the decumulation phase, the spending phase of your portfolio,
might be reading it a little more into it.
Downhill, you need more help, which makes sense to me, actually.
Fair enough. Like climbing Mount Everest, really should have help with this. Now, does Drew need help like a day-to-day thing? No, he could be set up and all automatic and you get going.
No, but the author of this says during the liquidation phase, you have less room for error.
That's right.
You're later in life.
The mistakes are bigger. Yeah,
the mistakes are bigger.
Yep.
They impact you more deadly.
Yeah, and I've said this before. That even if you are very confident in your plan, we get people to do this all the time, by the way, you should still have somebody in the business, full-time fee-only fiduciary looks at your situation and says, don't forget this, remember this, because none of us get all this right without help. Number 7, this is Don's, buying into the dream but ignoring the process.
I don't know what that one means.
Actually, I'd struggle with that one. He says, as an analyst, because you got to run the numbers. Second, as a coach, that one I think is a bit ethereal for me. A little odd, but
I mean, he says if you don't execute, you haven't really done anything.
Yeah. Exactly.
What does that have to do with buying into the dream but ignoring the process? So I guess dreaming is bad. Doing things is good. Okay, now I get it.
Yeah.
So stop dreaming and just do stuff.
Get started. Yeah.
It's wake up and smell the coffee.
There you go. Walk down Mount Everest slowly, when you're going down.
Yeah, well, and make sure you have someone to hold your hand so that if you slip and fall, you fall on top of them.
I'd be crying so they'd be carrying me. So, yeah.
All right. Well, those are our 7 deadly sins of wealth management for what they're worth.
It's fun. I think there's,
okay. I think it allowed us to make some points, but again, ethereal is a very, very good word to describe what these were. Yeah. They are.
Okay,
well,
we could do it. We could do it more. Have a plan.
Yeah.
Keep your costs low and pay attention to taxes. If you did those 3 things, you don't need all the rest of this. Although they are kind of part of it all anyway, but that would be pretty easy.
So we wasted all that time. We could have done it with that.
Can we roll back? I mean,
yeah.
Actually, can I roll back to when I was about 30 years old?
It'll be a podcast. We can roll it backward.
Please.
Nice. And unless you're not going to be there, I'm traveling across the country, as Wes alluded to, in the airstream.
Specifically avoiding you. I love that.
Yeah, he's fleeing to Tennessee as I'm going to be in North Carolina. I'm traveling up the East Coast, but inland along the mountain range. And you'll be here
eventually. Don will be in the
I will.
Seattle
I'm going to end up in the Seattle area in August.
Mid-August, yeah.
And then we're going to do the southwesterly route, hopefully.
Is that going to include Texas? Somebody asked me the other day.
Yes, that will include Texas.
Okay, there you go.
We'll be deep in the heart of.
Keep that clapping going there, son.
Anyway, want to know more? Go to TalkingRealMoney.com. That's TalkingRealMoney.com.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services. Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. Is anybody still listening?